To Larry Glazer, Scott Martin on this. Scott, it is interesting here that people who bet with their own money on what the Fed they think will do are now saying it's even money for a big rate hike in December. In fact, the money now goes against it being really too big, not like we'll get probably next month 75 basis points, likely less than that, probably a half a point. Do you think that's right? Do you think they're betting correctly?
Funny how the tide turns, Neil, almost daily, and I think it is right. I think the Fed is starting to realize from the data that's coming out, certainly from the market performance, not only in equities, my friend, but also, as we pop that up right there, and say the 10-year yield, which has been falling precipitously all week as equities have been rallying. So I think the Fed is starting to figure out whether it's housing numbers, whether it's consumer spending or confidence numbers out of businesses, they need to take a chill pill. And what that basically means is maybe a slower rate hike pace, 50 in November and possibly maybe another 50 or just 25 in December, and let this thing just kind of base out and see where the economic data goes. And they can always add more rate hikes if they need to, or they can just step off completely, say the beginning of next year, if the economy is indeed soft.
What if they are beginning to dial things back? Larry, I mean, we don't know that, and we're just making hunches here, but what if we've got it wrong?
You know, Neil, today was supposed to be about big tech and big earnings and also the big disappointments, right? Google, parent Alphabet, disappointing numbers, Microsoft, disappointing outlook. So the market perceives that bad news in technology. Every layoff is good news for the market because it sees that maybe this is just enough to make the Fed, if not pivot, pause, right? And maybe that's wishful thinking, Neil. It was wishful thinking in June. The market hears what it wants to hear. It believes what it wants to hear. It's just enough to get short covering, which you're seeing in the market. You did see today in Canada, they wimped out. I mean, Canada did not raise rates as much as people thought. So I think there's a hopium out there that in the United States, the Fed is going to take the same policy. But I think at the end of the day, the Fed is driving the bus here. Midterm elections are just around the corner. People are really focused. And as yields come down and that weakness is perceived in the market, and you see those weak new home sales, the market says, hey, that's good news. The Fed's had enough. Maybe they'll take a pause. Maybe we'll catch a break. Maybe we'll catch a breather here.
Scott, how much of this could be, and I stress could be, because you never want to get ahead of your skis on this, the market possibly factoring in a big Republican win on Tuesday, 2 weeks from now, beyond just winning the House, the Senate as well? What do you think?
I think, to use Larry's word, there's some hopium there too, Neil, that the market is going to see this gridlock that everybody, I think, is begging for, frankly, because at least at the very minimum, you're going to get the spending plans under control, I guess, and some hopium notations there. But it also speaks to the fact, Neil, that if you just look at historical performance of stock markets with a, say, split DC after a positive, let's say, midterm election result, markets do pretty well. And if that leads the Fed as well, or alongside the Fed, say, pausing here, you're going to have a nice operating environment, I think, for stocks here going into 2023.
Do you see the same, Larry?
I think it's a really bullish setup. If you look at history as our guide and we try to learn from these experiences, we know that we get a ton of volatility in midterm election years. We know that that's happened this year. We know the incumbents party tends to lose congressional seats. That seems likely based on the polls. And we know we tend to have twice the average return of the market in 12 months following midterms that we do in non-midterm years. So it is a bullish setup. Lots have to go right. The Fed is clearly in charge here. There's a lot of things considering. And we have a big tech problem in this country because big tech is too big a part of the market, but this rotation going on in the market is really healthy. We're seeing companies like Coca-Cola, all these businesses leading. If the dollar weakens, earnings will be okay, and I think that's really the message here. So I think midterms is a good setup. If the Fed stops, it is going to be good, and that is the hope today. That is the hope.
Come back and get more value. So that's actually exactly the setup we need to see, given that half of S&P earnings are coming from overseas these days, if not more.
We shall see the impact of all of that. I know Microsoft among those saying without the strong dollar, its foreign sales would not look nearly as bad. Larry, Scott, thank you both very, very much. You know, in this race...